Look around any major Indian city today, and the surface tells a story of booming prosperity. You see people stepping into premium cabs, their faces lit by the glow of 50,000 rupee flagship smartphones. It looks like the middle class has finally arrived. But beneath that glossy exterior lies a quiet, exhausting reality of financial survival. What looks like sudden purchasing power is actually an illusion of affordability. The ability to buy expensive items hasn't come from sudden wage increases. It's the result of an explosion in equated monthly installments, EMIs, which disguise long-term debt as a minor monthly inconvenience. This chart illustrates the macroeconomic squeeze driving the trend. This flat line represents median middle-class wage growth, barely moving. Now, watch this steeply rising line intersect it, the cost of living and inflation, encompassing school fees to food. With regular incomes failing to keep pace with these basic expenses, easy retail credit, available with just a few taps on a screen, became the only accessible bridge across that widening gap. This shift has turned the Indian middle class from wealth creators into debt servicers, caught in a cycle of monthly survival. They are working month to month just to pay off the lifestyle they've already consumed. It wasn't always this way. For decades, the Indian middle class ethos was built on strict thrift. Saving money was a virtue, and taking on debt, unless it was for a major investment like a house, carried a heavy social stigma. Then came the smartphone and the algorithm. Highly curated social media feeds turned daily life into a public performance. The old baseline of quietly saving for the future was replaced by the immediate pressure to project a successful consumer identity today. Millennials and Gen Z felt a desperate psychological need for status validation. They needed the right clothes, the right gadgets, and the right vacations to keep up online. Digital lending platforms recognized this exact vulnerability and engineered their products to exploit it. Modern consumption has detached from actual utility. Today, people are purchasing a socially acceptable identity on credit. Fintech companies have redesigned the e-commerce checkout screen into a carefully engineered psychological trap built to bypass rational financial thought. The main weapon here is called payment fragmentation. When you see a massive price tag, your brain registers immediate hesitation, the pain of paying. Shattering that huge number into tiny, non-threatening monthly bites completely neutralizes that hesitation. This taps directly into a human flaw called present bias. We are hardwired to overvalue the immediate dopamine hit of getting what we want right now, while severely underestimating the deferred pain of having to pay for it later. Platforms enforce this with dark UX, user interface designs that intentionally nudge you towards certain choices. They often pre-select the buy now, pay later option by default, removing all friction from the checkout process, so you slide into debt without making a conscious choice. The no-cost EMI label functions as a sophisticated behavioral engineering tool specifically designed to guarantee you spend money you don't actually have. Look at the mathematical reality shown in this bar chart. It traces a dangerously rising household debt-to-income ratio. We now see between 5 and 10% of middle-class borrowers taking out multiple personal loans just to cover daily consumption and pay off their previous debts. Debt payments are swallowing their entire paycheck. The consequences of this overleverage extend far beyond the bank account. It breeds a suffocating, silent stress. When borrowers inevitably fall behind on these stacked payments, they face chronic insomnia, severe anxiety, and crippling panic attacks. That panic is then weaponized by predatory, unregulated lending apps and recovery agents. If you miss a payment, they unleash a barrage of digital blackmail, sending threatening messages, making automated calls at 2 a.m, and publicly shaming borrowers to their family and colleagues. The complete erosion of mental resilience and personal dignity is the ultimate hidden cost of the EMI lifestyle, a toll far greater than any printed interest rate. There is a stark contrast between looking rich and actually being rich. The loud appearance of wealth is the glittering facade of brand stores and financed luxury, but true financial independence is entirely quiet and mostly invisible. The truly wealthy do use debt, but they use it very differently. For them, debt is leverage. They borrow capital to acquire income-producing assets, like real estate or businesses, that pay them back over time. The middle-class trap does the exact opposite. Here, debt is utilized to acquire depreciating liabilities, things like electronics, clothes, and cars. that continuously drain future income without generating any returns. The defining difference is simple. The wealthy use debt to buy themselves time. The middle class uses debt to steal from their own future. Escaping this cycle starts with recognizing no-cost offers and instant credit buttons as behavioral traps designed to seduce you. Breaking free requires reviving the principle of delayed gratification. It means stepping out of the social media rat race and prioritizing long-term asset building over the need for instant status validation. True wealth will never be measured by the luxury goods you manage to finance. It is measured by the ultimate luxury, owning your own freedom and your own future.